So much to tackle, so little time. So let's bring in the floor show. Joining me now, Carl Riccadonna. He's the chief U.S. economist at BNP Paribas, and Dutch Masters, the CEO of Carnivore Trading. All right, Carl, right off the bat, good news, which was the jobs number, bad news. So does this cement what the Fed is expected to do? I mean, we could pull up the Fed funds futures right now, and folks, this is the brand new number that has just come out. I think 82% chance of a 75 basis point hike.
I think this number really does cement their plans. So at the last Fed meeting in September, they kind of laid out a general expectation of 75 basis points in November, an additional 50 in December. These data support that. And we saw the versions of good news and bad news this week, right? Earlier in the week, we had that weak manufacturing survey, stocks ripped higher. Next day, we had the weak JOLTS report. Not weak, but weaker than expected. Stocks ripped higher. Today we get strong data, good news, and stocks are down. So it's a good news is bad news is good news kind of market, because it's reinforcing that Fed messaging. It will be very hard to steer away from a 75 basis point increase in early November.
I'm afraid
with not a lot of data in the interim.
I'm afraid to ask Dutch what he thinks. I mean, Dutch, we are specifically looking at the 75 basis point hike if it were the meeting to be today. Listen, the Fed would argue it's got to bring prices down, it's got to cool the economy, and this jobs number shows it's not happening yet.
Yeah, I can only hope that the next 3 weeks we get some data that pushes them to maybe do 50, but I really doubt it after today, and I agree with your guest there. I think we're really going to have a 75, and that's what the market's pricing in right now. And what's crazy about that is we already took the world economy to the brink. We were breaking some currencies. We were, really getting central bank intervention was having to take place in other countries to shore up their currencies. We've got parity in the euro. We've got Japanese yen. I mean, the dollar was pulling back because of the interventions, but now it's rising again. We've got a 10-year that's heading towards 4%. And probably higher. I don't see equities having a great chance of going up in that kind of environment, which is why, we really use those inverse ETFs of SPXU and SQQQ and TECS. And we've been using them. We flipped out of some of our longs and protected our gains that we had in the longs last night with a big chunk of SPXU. And we were up 1% this morning right out of the chute. So
well, it's up 8% now. I mean, that's a great trade if you're shorting the markets. I'm looking at this at the moment. And look, you got to figure, Carl, that when you start betting against the market, then you're now going to have a possibly weaker market. Earnings season is coming, right? How do you expect that earnings season will play out? I think it's pretty obvious that the momentum names that had ridiculous valuations in the tech world are going to propose a really ugly picture.
Well, without diving into single name stocks and that sort of thing, just to lay the macro landscape, right? We know the economy is decelerating massively. Had I been sitting in this chair a year ago, I'd have been talking about GDP growth that was printing around 12% for the U.S. economy. And unrealistic number. The last time we grew that fast was 1950 in the U.S. So we knew it had to slow, and it did. By the end of last year, we were at 6%. By the middle of this year, we're at 2%, and we're heading to something that is very close to zero by year end. So you still have lingering high inflation, right? That compresses margins and very slow growth, which the bottom line follows the macro data in the economy. So that's the challenging environment that we're going to be confronting in the next earnings seasons. And we've seen warnings to this effect from package shippers and retailers.
Well, sure.
Demand is cooling.
Inventory. Everybody's overstocked.
Excess inventories.
Dutch, profitless tech. How's that going to do going forward? I mean, is there a way to short that? I would have figured you've been thinking about it.
Yeah, I mean, when you've got, I mean, I don't know the specific other than to go to specific names, but yeah, when you don't have any profits and you're a big tech company, I mean, you're the longest duration vehicle out there, right? And the long duration is what's really going to get hit. At some point, we think the Fed is going to have to make a decision between wealth and economic destruction and inflation. Now, they haven't made that decision yet. They've stuck with trying to fight inflation, but the truth of the matter is that what they're doing is not going to change the kind of inflation that we have.
Well, We can only hope, because I know if people are choosing right now between getting prices down and maybe a mild or shallow recession, they would like to see prices down, especially as we head into the holiday season. Carl, Dutch, we've got to leave it there. Great to have you on. Thank you both so much. We really appreciate it.